Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have a fairly lengthy show, but we're going to cut it down in terms of some of the different pieces because there's a lot of slides, but they're just reinforcing some of the key points, especially when we start getting into segments 2 and 3, where we just want to look at how is the consumer reacting and what are they saying. And we're going to talk about that in a minute. But let's look at what we're going to focus on. So in segment 1, we're going to talk about what happens to global debt as the Fed hikes, because as the Fed does things, it has knock-on effects. And when you look at the knock-on effects, you have to consider rates, but also what is happening outside of rates, global unemployment, commodities. Some of these key components are going to drive that global economic growth. And we want to look at how is that going to resonate as we get these broader shifts. Then in segment 2, we're going to talk about, well, the Fed started hiking and they're hiking into a recession. What does that look like? Why is that happening? And why are we saying a recession? Like, what are we seeing that is pointing us to this is coming and it's inevitable? And then obviously the question is it going to be a hard landing, soft landing? And we'll go through some of that in segment 2. And then segment 3, we're going to talk about how the leading indicators are really pushing us towards that region and the problems that we're seeing as that accelerates and how is that accelerating in housing, in the consumer consumption. And that's where we're going to have some of these different slides, because there were a lot of surveys that came out, and we're just going to look at what those surveys said, just so we have some of that supporting data. Then we're going to talk about the ECB call. They had an emergency meeting. Nothing came of it, but we want to talk about what prompted them to do that and what are some of the things that are happening, concerns that are in that region. And then in segment 5, we're going to talk about the big data dump that we had from China and some of the issues that continue to grow in India when we look at inflation and underlying growth. So now when we turn to segment 1, we want to look at the leading indicators. And the OECD nations, a lot of developed nations, really lead what happens throughout the rest of the world, especially because the developed nations are usually the biggest buyers. They're importing, they're creating different things, whether that be raw materials, semi-finished goods. And as the leading indicators really start to turn lower, that has that knock-on effect that we've been talking about. And this just puts it into perspective on where are we heading. And again, you can see that the diffusion index is quite large. There's an 8-month lead time, but it gives you an idea on the direction. It's not so much that, oh, look, we're instantly going into a global recession. It's just we're heading into a slowdown. What that slowdown looks like, the pace of it, is something that we're going to flesh out over the next hour or so. But we want to look at, this is where things are going. This is the pressure that's coming into us. And it's happening as global central banks, not just the US, global central banks are raising rates. We had another raise from the UK. We had another raise from India. Obviously we had a big raise from the Fed of 75 basis points. And we want to look at, well, all of this is happening as things were already slowing. So you get a global tightening situation as these countries try to get ahead of inflation and try to get themselves up that curve. Now, while all of this is happening, you still have the dollar, which is still maintaining a certain amount of strength. Now, it's at 104. We see a lot of staying power, 104, as there's a significant amount of problems around the world, with one of them being the Bank of Japan that is trying to maintain that yield control. And the market is essentially betting that they're going to have to adjust in either they're going to get much bigger in what they're buying, or they're going to have to yield, and you're going to see some of this snapback in the yield control curve that they're trying to do. I should say the yield control they're trying to do. But in the meantime, you still have the dollar, which is remaining strong, while commodity prices still remain very firm. Now, there's a certain amount of disconnect that can be maintained, and it's just because there is a volume problem or a supply problem when you look at some of these key areas. But as demand really accelerates to the downside, that's really going to adjust some of those economics. And we should see this converge a bit. Not that it has to converge right away, but you can see just how wide it has gotten. And there have been times that it's been this wide before. It's just typically you get a bit of a snapback, and we do believe that is coming. But in the meantime, you have a strong dollar, and you have a significant amount of sovereign debt and international company debt that is denominated in dollars. Now, it's very important to appreciate that this really accelerated in 2014 as the dollar index and the US dollar got much weaker. So realistically, you had companies and countries that wanted to tap into a lot of this free money and these low interest rates. So why not get rid of one of those hurdles, which is the currency in which it's traded in? So instead of having to worry about interest rate swaps and converting it from, whether that be the euro or the rupee, now you could just have it in dollars, and now you reduce the cost. You have a certain amount of staying power, but as the dollar gets stronger and global trade weakens, the cost of maintaining that is going to become very difficult. So not only do you have the Fed raising rates, which is going to make it difficult for countries that have to roll debt or issue new debt, because it's going to be at a higher interest cost, which means interest expense is going to come up, which is going to put more pressure on the government. It's also going to drain company resources, because companies are going to have to pay that debt. And as what they're transacting in diminishes in terms of local currency as well as their dollar holdings, because trade is slowing, so they're bringing in less dollars naturally, and then the local currency is weakening, that dollar denominated debt gets more and more expensive, and we're heading, essentially head first into a very big problem as rates continue to move up and the dollar remains strong. And this is just giving you an idea on what the market is pricing in. It's not saying that it has to happen, but you're getting some of this view of where these monetary policy and how it's normalizing in some of these areas, and what does that mean? Where do we go on those levels? So as we heard from the Fed, they're expecting to get to about 3.2% by the end of this year, but 3.8% on the Fed funds rate as we get into the end of next year, and then actually start to see cutting in 2024. But when you look at the pressure that we're seeing, you get an idea of where it is in New Zealand, in Canada, in Australia. The ECB is now going, but even when we look at this and we look at the rates getting more normal, you have to appreciate what are real rates, and not the real rates that are being calculated, but against inflation as we know it, which is close to 9%. Well, even at a 3% Fed funds rate, we're still looking at a negative 6% real rate. So how much upside pressure are we going to see? Not to say that they're going to feel the pressure here because they'll manage it, but what does that do to high yield debt, to investment grade debt? Where does that pressure come in? Because they're like, yeah, I know that the risk-free rate is 3%, but when we look at the real rates, you need to cover some of my inflation. What is that arbitrage going to look like when they start playing the short one versus long the other to try to collect that? And again, these are some of the key pieces that you want to look at and understand when we look at yield curves, when we look at what is Fed policy going to do, how is it going to drive other policies and other currencies, and where those pressures are going to come through. And that's going to put more pressure on the manufacturing sector, on global composite PMI, because as the cost of doing business gets higher, as the cost of employees, as the cost of everything goes up, not even just because of inflation, but because of dollar strength versus local currency, that's when you get that accelerating slowdown. That's when you see, people and companies saying, we can't afford to do this at the same rate. We have to pare back. And that's why when you look at the expectations is for this to go negative. Now, the question is, when does the manufacturing sector go negative? Is it Q3, Q4, Q1? That's where we dig into some of the micro data to say, okay, well, based on what we're seeing in Europe, it's already happened. In the US, it's Q3. In Asia, it's going to be Q4. but the trend is all the same. And the question is going to be the rate at which it comes down and where does it start to flatline? Is it just slight growth? Is it slight negative growth? Is it something much worse and a bit deeper? And these are the kind of things that we want to look at as some of these leading indicators and indicators get a bit worse. Now, a key component, I think, and this is really important, is the unemployment rate of the youth when you compare it to the EU, when you compare it to China. So right now, China's youth unemployment is 18.4%. Now, Eurozone as of April is 13.9%. So when you look at China, it's better than countries like Portugal, Spain, Sweden, and Greece. Young people are struggling to find jobs around the world. So when you look at the ability to spend, the ability to do things and go out there and really build a family. And I was having a great conversation earlier on, some economists like to say, oh, well, because women are in the workforce, they're less likely to have a child, or, because they're working, they don't want to have children, or they're waiting later in life. But at the same time, what is the cost of raising a child? What is the cost of doing that? So it's not that, oh, women are working, they don't want to have children. It could very well be, well, women are also good at math and they're looking at this and saying, honey, we can't afford children, or we can't afford more than 2 children. So the demographics, and this is when you start coming into the importance of maybe a little bit of a deflation washout, something to right the system, because the job problem is still very alive and well, while we have an inflationary backdrop. So we were joking, and for someone, I have 3 children, so you get a car seat that's made out of plastic, and you're like, how is this thing $400? Like, I don't understand where and again, I do understand, but it doesn't mean that I can't be angry about it or complain about it, because you look at all these things, it's like, at what point do we have to deflate some of these prices in order to fix the demographic problem, really start to adjust that? And we've covered it before. Childcare is through the roof. Insurance is through the roof. Food, all these things. So, housing. So sure, maybe a family wants to have 3 or 4 kids. Can they do it in a 800 square foot apartment? Do they want to do it in that apartment? And the answer is probably no. So again, these are some of those key pieces that are going to lead to longer term demographic issues that are that overarching problem when you look at it. And it's not because women can read now. That it's just it's an insult to women, and it's intellectually dishonest, because you have to look at, people are looking at their balance sheets, their what are they going to make, and can they afford a family? And the resounding answer is no. And that's why when you look at the problems in Europe, that's only getting worse. And we pick on Europe because they have a very clear population problem. But let's look at just gas demand. Like gas demand in Europe in the industrial sector, the industrial sector makes up a huge part of gas demand that is coming from Russia. So as Russia's not sending in natural gas, or there's going to be this fallout, well, where are we going to see the most pain? And how is that going to impact inflation and prices going forward, which is only going to stress a family, a consumer, that much more with housing where it is. And again, why the ECB called an emergency meeting, not that anything came from it, but these are the stress points that we keep talking about. And this is where pricing is going up, and there's a lot of staying power. Even when you start looking at how Russia and the relationship between Russia and Europe continue, Russia, the rest of the world, obviously China and Russia are entering into some deeper contracts. But China still gets $1.7 trillion a year of trade from the U.S. and her allies, and $100 billion in trade from Russia. Yes, Russia provides the energy to run that $1.7 trillion, which is why we and our allies will never stop China from buying energy from them. But you get an idea of what that's going to do and how that's going to shift pricing and really keep the foot on the neck of the European economy when you look at some of these underlying underlying pieces, and increasing costs is going to disincentivize people to have children, going to create that longer term problem that I think really needs to come back to the forefront of how do we change this dynamic and this trajectory, and what is it going to take? Now, when we look at the decoupling, and this is, I think, a really important piece when we talk about agriculture, because the biggest issue we're having right now is yield. Yield is rolling. Now, there's from the private equity side of the fund that we run, we're investing in some of these these fertilizer solutions, but there is a problem in terms of how are we going to feed a growing population? Because even though there's obviously a demographic issue, it's not everywhere. The population is still growing, and it's hungry. It's going to need food. And when you look at the shift in terms of reduction, so global pasture land has come down, croplands are going back up, but you still need meat. You still need grains. And the problem now is, how do you adjust that? Because some of the new croplands coming back are not in the greatest position, are not going to yield the most. So how do you repair it and enable it to increase the amount of yield that you're going to need in perpetuity in order to feed this growing population? Because we have a fish problem, we have a meat problem, we have a chicken, pig problem, and we now have a grain problem. And as we've been talking about since the end of 2019, we did shows on it in 2020, food shortages don't just show up. They take time to build out. They take time to whittle down the inventories, and this is where we're going to continue to find some of these bigger problems. And a lot of them are going to be in Africa. And we're just picking on Africa for a moment and the Middle East, but we've already seen issues in Latin America between Ecuador and Peru, where as the weather gets worse, as we have more flooding, as we have more droughts, as there's an impact to the underlying food security problem, this is going to obviously expand to broader areas. And this is just an example of the amount of people in crisis or emergency food insecurity. And the food insecurity continues to grow. And as that happens, people will take matters into their own hands. Because again, if your family is starving, what will you do to feed your family? And again, these are some of those key pieces that are happening throughout the world. This one just happening to focus in on Africa. Now, just taking that to the next level, this is where when we just pull and look at one location, you get an idea on drought and how the drought has continued to worsen against the average from 1981 to 2010. So the drought is getting worse, which means that they're draining key resources. And as those resources are drained and you rely on more irrigation, and then water starts to run dry, and then you start to see yield drop, well, food insecurity gets much worse and creates a much broader problem, which is why when you look at this and then look at WASDE and some of the other pieces that are coming out, then you get an idea on the wrong direction in which we're heading. So corn piling up. So the U.S. didn't budget its forecast for corn exports, holding it at only 9 million tons, even though, again, they're trying to do things to get that corn into market. But again, you'd have to demine, you'd have to secure, and there's a lot of problems with that. The U.S., in terms of the wheat side, the U.S.'s most widely grown variety of the grain got cut even more this month. Production of hard red winter wheat is seen falling an additional 1% after severe drought ruined some crops. USDA in May forecast the lowest output in wheat since 1963. So again, you're getting multiple stress points, and if you think about just the breadbasket states of the U.S., that's going to limit the amount that is available to get sold into areas that are seeing stress, that are seeing problems. Soybeans, traders were looking for a boost of U.S. exports. The USDA, we had that increase. So we're seeing more of that go into the market. But when you look at Brazil is still facing a drought. And so as Brazilian soybeans come down, U.S. coming up. So we're not really making headway on that side, because you have to look at crops as knock-on effects. Because if you can't get one, you'll go to the other. If you can't get both, you go to a third. And that's if you can't get fish, you go to chicken. If you can't get chicken, you go to pigs. If you again, you're going in different directions, trying to feed your family, trying to feed your country, and that's where we continue to see those pressure points, which is why inflation has that stickiness that we're talking about as their pressure comes in and the food isn't available. Now, when we look at WASDE in terms of what the U.S. had for global ending stocks, here you can see that corn was a bit higher. Same with beans, as wheat got a bit worse. So when we look at wheat futures, things are starting to shift. We're moving in a direction, but it's still at a very slow pace. When you factor in the underlying issues in terms of growing demand, reduced availability in other meat areas and other grain areas, which is again keeping that pressure on the market. So now when you start looking at equity flows and how this is resonating with people, cumulative equity flows, money is still coming into the U.S., and we're going to talk more about that in segment 2, while we continue to see some money coming out of emerging markets and Europe. And we do think that there's going to be an accelerating move out of some of these emerging markets as rates really start to bite and defaults start to get a bit worse. And this is why when you look at the global Optimism is at the lowest it's been in going back to 1994, and the lowest point is you can see that the circles in terms of other recessions. So when you look at this, you get an idea of just how the expectations are there, but how are people positioning? And that's why when you look at how people are positioned and the fear, you have to keep coming back to food, because food and safety is going to really drive this. So when you look at global new crop corn supplies coming much higher than expected based on a bigger Ukrainian crop. But again, even if it's bigger, and there's been a lot of questions on how much bigger could it be. There's not as many people in there checking it to make sure that it is the size it claims to be. How do you get it to market? Which is another issue. Soybeans coming above expectations, but wheat slightly below. And then there's no change to some of the Chinese data as Brazil and some of the other Latin American nations get a bit worse, which again is reducing some of those expectations. So now when we start looking at trucking demand, and this is just looking at the U.S. for a moment, trucking demand is struggling in the U.S. and it's getting worse. But as the U.S. worsens, if the U.S. sneezes, everybody catches a cold. We are the world's largest buyer. So trucking demand is that leading indicator of, well, what is happening at the wholesale retail sector. And that's when we're seeing a lot of these slowdowns. And as we talked about in the EIA show, tender rejections have reached a new cycle low at 8.13%. And that's when you look at the spot rates, they've dropped over 1/3 since mid-January, from $3.01 per mile to $1.95. And again, we see that coming through. And then when we look at coming in, container volumes bound for the U.S., mostly retail goods, have also dropped, again, keeping that pressure going forward. Now, as we look at Russia and Ukraine, as we've shown this chart before, account for 1/4 of global grains trade. And as Russia is withholding some of this from the international market, what is that doing to underlying pressure and availability in other markets? And we all know that it is driving up prices, as well as they account for 1/5 of global fertilizer. So when you look at Russian exports of nitrogen, phosphate, potash, and this obviously doesn't include Belarus, which really should be in there, you're seeing a huge component of the amount of tons that get put into the market, and why there's not only an issue on just crop availability, or I should say grain availability, but also the nutrients needed to maintain yield, calling back into question, again, that inflationary piece and that disconnect between the dollar and commodities. Well, if you have not as much supply and demand, people need to eat. Well, even if the dollar gets stronger, how are you going to see commodity prices come down because of the shortages? And that's why we see some of these different disconnects. Now, when we look at the war in Ukraine, you get an idea of some of the things that we have been talking about. where the counteroffensive that the Ukrainians are launching continues in a lot of areas, including Kharkiv and other pieces of Izium and Donetsk and the Luhansk Oblast. Because when you look at the different pieces, so the furthest points east, you're seeing more movement, and Russia is making some headways through those areas. But then around Kharkiv and around Mykolaiv, you're seeing that there has been a fairly successful counterattack. And then when you look at this chart to the right on the Oblast, you can see that the Ukrainians have been able to recapture on the counteroffensive. But when you look at where the line started, Russia still holds some of this new land that they had essentially taken from the Ukrainians, but they're starting to see some pockets of resistance in Kherson and other areas. And this is where, as we've been saying, they draw in the Russian troops and then start hitting in the rear to really cut off the supply chain and then start that pushback. So right now there's small gains on both sides, but really not a huge movement in one direction. Now, on the other side, when we look at the furthest east in Luhansk over, you can see that the Russians have continued to consolidate some of these positions as the Russian forces claimed more control on Tashkiva, as well as other areas. But when you look to the north in terms of Kharkiv, you're seeing that the Ukrainians have now officially taken even the outer rim of the city back under its control and are continuing to push back. So this is where the Ukrainians are essentially stopping the expansion on the north and the south and giving up some of that land when you consider coming from the furthest east-west. Now, again, this is where we continue to see this stalemate. New equipment is coming into the Ukrainian from Eastern, Western Europe, as well as the U.S., as Russia continues to struggle. Now, there is concerns that Belarus might enter the war, but again, so far those are rumors. They had some military tests, but it still remains unlikely that we see them come back and try to come back into Kyiv, as the focus remains on the eastern side of the Ukrainian and Russian borders. So again, these are also things that are going to keep pressure on everything in terms of commodities, because Russia is a huge exporter of commodities. The Ukrainian is a big exporter of commodities, and right now they're continuing to be essentially locked behind a wall of conflict that we don't see ending anytime soon, keeping that pressure in place. So that's what we have on the global side. In the next segment, we're going to go much deeper into what the Fed did, why does that matter, and what are going to be some of the knock-on effects, which will then carry over into segment 3.